Hello, my name is Murray Wilkinson from Future Gen Solutions, and this afternoon I'd like to have a chat about property. Specifically, we've been noticing the falling trends of property clearance rates in Sydney and Melbourne. And the question has to be asked, I know we've raised this previously, as to whether this trend is going to continue. Well, our view is, if you look at historically, we've got a bit of global resynchronisation going on. And what that actually means is that previously, after the global financial crisis, we had the advent of very cheap money. And that was called QE, quantitative easing, where all the banks around the world were basically letting free cash go out through the coffers to keep the economies moving. Well, unfortunately, that's reversed now. We actually have QT, quantitative tightening, and that's happening now both in the United States, in Europe, and certainly here in Australia. The interesting thing in Australia is that our Reserve Bank hasn't been raising rates, but as you'll notice, particularly last week, ANZ, Commonwealth Bank and Westpac have all raised their rates. Now, why is this so? Well, the interesting thing I think we should note is that the Reserve Bank now of Australia is a bit player in the interest rate cycle. Over, as I understand, 35 to 40% of money now is accessed by our banks from offshore, and as a result we are importing those rising interest rates. And the interest rates we set here are actually in line with world rates, so we're a global bit player. For that reason, the outlook is certainly that rates will rise. I think the other thing you've got to think about also is that the Australian Prudential Regulation Authority, APRA, they've also set a ceiling on interest-only borrowing by banks. If you go back 2 years ago, interest-only borrowing has now reduced by 30%. And they're insisting that people, whether they're investment properties or own mortgages, pay down those rates, pay down those loans they have on a principal and interest basis. So that's had a big impact. We've also seen the effect of glut of apartments around Australia, and the fact that many banks won't lend to certain postcodes and certainly won't lend to certain apartment projects. All these mean for us that the risks of a credit crunch are getting higher and higher. And credit, as we know, is getting harder to obtain, particularly if you're in small business. So, they talk about rates normalising. What does normalisation mean? Well, if you look in the long term, normal rates are around 6 to 7%. That's the actual rate that people are paying on a home loan mortgage, close to 7. So in reality, our rates might have another 200 basis points to go before they're regarded as normal. You've got to ask the question, what would that do for a lot of people who are highly geared and highly stressed around this country? So will property rise? I have to question it. I can't see how it can. We need incomes to rise, and incomes, as we know, aren't rising around Australia. And incomes can only rise if top-line revenue growth in major companies starts to rise around Australia. We just had the reporting season go past, and it's been noted that top-line revenue growth in companies isn't occurring. So once again, the debate's starting about how do we get incomes to rise. So with all these factors together, it seems to me like it's almost a perfect storm. So my advice to people is be careful. If you've got lines of credit and facilities, make sure that they are that you have access to your reserves, that you don't hand them back to the bank. They're certainly useful. And if you're looking to basically borrow, think good and hard before you do so. So hopefully I've been able to impart some thoughts from Future Gen Solutions this afternoon. Bye now.